Welcome to the Excel in Property Real Estate Financial Modelling crash course. If we haven't met yet, I'm Lucy Gordon, your instructor for the next few days. I specialise in analysing opportunities for investors, developers and operators across the real estate industry. This crash course is designed to give you a clear, practical overview of how real estate financial modelling works and how to build one that actually helps you make better decisions. Whether you're modelling for investors, developers or operators, this course gives you the foundation. My goal with this training is simple: to help you build models that make sense, get used, and support the kind of decisions that move deals forward. In this first lesson, we'll walk through the blueprint of financial modelling. Then over the next few lessons, we'll build out each part of the model together. Let's start with a simple question. What is a financial model? At its core, a financial model is just a structured forecast, a way to estimate what might happen to a property or portfolio over time. A real estate model has three core elements. The inputs. These are the assumptions you make about the deal. Things like the purchase price, rent, operating costs, loan terms, and the future sale value. The second part are the calculations. These are the formulas that take your inputs and automatically generate the cash flows, so you don't need to manually update every line. This is where modelling starts to become really powerful and why strong modelling skills are so valuable in real estate. The final element is outputs. These include your projected cash flow and return metrics like IRR and equity multiple. These help you test the feasibility of a deal and compare different opportunities. Those three parts, the inputs, calculations and outputs, make up every financial model, and we'll be walking through each one of these in the lessons ahead. If you take the time to build models properly, you can massively improve the speed and quality of your analysis, and ultimately your value as a real estate professional. To help with that, we've developed the SMART modelling framework. It's a simple 5-step approach that we use in our consultancy and training. The first step is the scope. We start by defining what the model needs to do. What are the key deliverables? What do we want in the model and what don't we need? A bit of planning at the start will save hours later on. The second phase is, of course, the model. You build the model based on the scope. The structure should reflect the specific details of the deal and give you the answers you actually need. Once built, we audit the model. So all the models are checked carefully to make sure, are the numbers flowing correctly? Are all the formulas working? Does it reflect the right assumptions? Our fourth step is a review. This is when you walk your stakeholder through the model. They might spot gaps or ask questions you hadn't considered. And this is a normal part of the process. Finally, we have the transition. This is the point where we make sure the model can be picked up by someone else. That means clear labelling, logical layout, and supporting notes or documentation. If you follow this method, you'll end up with a model that's accurate, useful, and built in half the time. We recommend following this method both when building a financial model from scratch and whenever you're looking at a new opportunity. So why do financial models matter in real estate? Because real estate is capital intensive, slow moving, and full of risk. Decisions get made months, sometimes years before you see the results. A good model lets you test scenarios before making commitments. Things like, should we buy this asset? What happens if rents don't grow? How much debt can we take on? Will we hit the return hurdle? A good model doesn't just tell you what might happen. It shows you what could go wrong, and that's critical for managing risk. Here's the bit most people skip. Modelling isn't just about accuracy. A good model is structured. It's built in a clear and logical way. It's flexible, so it's easy to update when things change, and it's decision ready, designed to answer commercial questions, not just tick technical boxes. If you've ever opened a spreadsheet and felt totally lost, that's bad structure. If you can't explain the model to someone else in 5 minutes, it's too complex. The goal isn't creating a perfect forecast down to the nearest penny. It's about creating something that provides clarity and drives investment decisions. So that's it for the blueprint. Now you know what a model is, why it matters, and what makes one worth building. In the next lesson, we'll open up the model and start looking at our first core element, the inputs. I'll see you there.